401k match, okay? And it's just typically anywhere from 4 to 6%. I've seen some as high as 10, which is just amazing. And so taking advantage of that could be huge. I mean, I'm sorry, but that's just wrong. I apologize. I know I get fired up on this one, guys, but this is just bad info. But this whole thing about Wall Street is just bunk. It's not true. All right, and welcome in to another episode of CFP Reacts, where I, your host, Scott Schiller, your certified financial planner, reacts to the best and worst financial planning advice in social media. And in today's video, we're going to be reacting to a video on the 5 pitfalls of the 401k plan. All right, and so a lot of my clients have 401k plans, and so I thought it would be something relevant for everyone out there that has one, as well as if we're working at a government organization, a state or a municipality, we may be offered a 403b plan, and so this would be relevant for you as well. And so this video is from Minority Mindset. It has over 300,000 views, which is a little bit scary to me because there's some really crazy information in here. And so let's jump right into it.
Are the most popular investment vehicle in the United States, but the studies show that most Americans have no idea of how they work. But that stops.
Yeah, most Americans don't know how they work, and that is true. That's a great reason, shameless plug, to work with a good certified financial planner to help you out there. But you know, in general, financial planning, most of us, we think we know, but we actually, in reality, most Americans have no idea what's going on with their investments.
Today, because I'm going to be going over 5 things you need.
By the way, let me pause it here. I love this at the bottom. At least he has the disclosure here saying, hey, I'm not a financial advisor. I'm just a guy on YouTube just giving you advice, okay? And which is why I started my channel in the first place. I am licensed. I am a certified financial planner. I do have to get this information approved before I'm able to post it. So that's why so many of you guys like tuning in and watching my videos, is that it gives us a professional's view of this stuff. This gentleman is not a financial advisor.
You need to understand about your 401k, from your taxes to your fees, because yes, your 401k has a fee. Number 3 is control. Number 4 is limitations. And number 5, alternatives to your 401k. That way you don't make the same expensive mistakes that millions of Americans are making. So let's jump in with number 1, talking about taxes. Roth 401k or a traditional 401k. So let me start by talking about the traditional 401k. If you make $1,000 from your job, and then you put this all $1,000 into your 401k, that means all $1,000 gets to go into your 401k. The money then grows in your 401k for as long as your money is sitting there.
Yeah, and this right there is the reason why the 401k is one of the best wealth building tools, is you're able to take pre-tax income, right? Money we've earned that we haven't paid any taxes on, and it can go to work for us right away.
And then when it comes time for you to retire, hopefully this $1,000 will grow to say $10,000. You pull out $10,000 out of your 401k. That's when this money is going to be taxed. So you get taxed when you pull the money out, but all $1,000 gets to go into the 401k. Where the Roth, it works a little bit different. Now, you make that same $1,000 and you want to invest this money into your 401k. But before you do, you pay your taxes.
And this is going to be, yeah, and this is correct. This is going to be true of the Roth IRA, the traditional IRA. Traditional IRA is going to be pre-tax income. The Roth, either IRA or 401k, is after-tax money.
So now the money is taxed before it goes in. Now, depending on what your tax rate is, meaning how much money you make, you might be paying, say, 30% of this money in taxes. So now only $700 goes into your 401k.
All right, so just quick note on 30% in taxes. You know, when we look at a tax bracket, you know, our tax system is a progressive tax system. So the first dollars that we earn, we're not taxed at all, and then the taxes go up the more that we earn, okay? In effective, the most best way to determine what our tax liability or how much we're going to pay in taxes is to use what's called your effective tax rate, which blends everything together and gives you a true percentage of what you're actually paying. To be in a 30% effective tax rate, your income would need to be extremely high, and many of us out there have that, but a lot of us don't, okay? And so an effective tax rate at even 20% would be a high income, something around $250,000 or higher.
Your 401k. So you have less money working for you, but then when you go to pull this money out, you don't have to pay any money in taxes when you pull this money out. So if the $700
The reason why is because you've already paid your taxes. You don't need to pay again.
grows to $7,000, well, now you don't have to pay taxes on the $7,000 because you paid taxes here before the money went into the 401k. So you still have to pay taxes. Your 401k just said to defer taxes when the money is growing inside of the 401k. With a Roth, you pay taxes before the money goes in. With the traditional, you pay taxes when the money comes out. Now, when you're making the decision of which one's better for you, a traditional or a Roth, the main question that most people ask is, well, when I go to retire, what's my income going to look like? I'm not going to have a job, so I'm not going to have much income. So my income is going to be lower, so my tax bracket is going to be lower.
Not necessarily true. A lot of us want our income to stay level or go up in retirement, right? And so, or continue to go up. We need to keep pace with the cost of living expense. Inflation is an issue in retirement, right? We don't want to just have our income be flat. And so all of this is part of a good financial planning process that I help my clients through, which is, okay, let's figure out and let's find out how much income we ultimately want in retirement. And there's a very simple way to come up with that, and then determine where we need to go from there. But what he's going to get to is playing this game of, do I pay taxes now or later? And it's just truly just a guessing game.
It'll be lower. So because of that, I should pay taxes when I pull my money out, which might work for some people. But for others, that might not be the best analysis, because if you are, let's call it more financially savvy, and your goal is to grow your investment income, and by the time you retire, you don't want no income, you want a lot of income, well, then you would have a higher tax.
Well, you don't have to be investment savvy to want that. I would think everyone would want that. You don't have to be an investment guru to want a lot of money in retirement.
Your tax bracket. Not to mention, you want to pay attention to what's happening in the economy as well, because we know that our national debt is always breaking new record highs, and our government keeps spending more money, which means our government has more and more needs for higher taxes, which means that there's a potential reason to believe that we will have higher tax rates in the future, which could impact how much money you pay in taxes again in the future. But you got to pay attention to what you're doing in your personal finances and what's going on in the broader finances to decide what's better for you, a Roth or a traditional.
That is true. He's right about that. That is a great point. It is good to have a good plan put together to determine which one's going to be better for you. But in his example, let's look at that. The traditional side, it says $10,000. Well, I have to pay full tax on that, right? Well, again, when we look at an effective tax rate, if it's at 20%, that means my income is still very, very high. And I'm going to be walking away with $8,000, $10,000, 20%, $8,000 left over. Well, 8 is more than the 7 there in the Roth, right? And so it's either I pay taxes now or I pay taxes later. Now, one thing that's nice in a lot of 401k plans is the option to use either one, right? And so if we don't quite know or don't want to speculate which is going to be better, maybe we do half into each.
If it was me, I would prefer a Roth, but again, I'm not you, and I'm not a financial advisor. I'm just a random guy on YouTube.
He's not a financial advisor.
YouTube. The second thing that you want to pay attention to are fees, because yes, your 401k is costing you a fee. This fee...
No, guys, I'm just going to skip over this one, and excuse me, I'm going to jump ahead for us here.
An additional $500 down in the description below. The third thing that...
Okay, here's why I skipped over the costs. The 401ks that I look at and the ones that I've owned and personally, the costs are extremely low, okay? Relative to almost every other securities investment, the cost in a 401k plan are very, very, very low, okay? Certainly when you're looking for any kind of financial advice or anyone to help you, they're going to be very, very low, okay? And so it's just, to me, it's just such a non-issue, I just skipped right over it.
I need you to understand about your 401k has to do with control, more particularly control from your employer and control from Wall Street. When it comes to your employer, some companies will offer you a 401k match, which says for every $1,000 you invest in your 401k, your boss is going to give you an additional $200, an additional $500, maybe even an additional $1,000. They'll match it at 100% contribution. But what you got to understand about this is some employers are going to put restrictions on how this works, meaning a vesting schedule, which says that in order for you to actually get that money and keep that money for yourself, you have to work at the company for at least 5 years.
Yeah, and that's true. And the reason why is because, look, the business is just giving you money, right? And so they're investing in you. And, this is a contract between us, you as the employer and the business is hey, they're asking you for your skills and your labor. And in return for that, they are offering you these benefits, right? And one of them should be a 401k match, okay? And it's just typically anywhere from 4 to 6%. I've seen some as high as 10, which is just amazing. And so taking advantage of that could be huge, right? Doesn't mean it's always the best option, but it's certainly one we definitely want to look at because getting that match is really nice to have. Again, it's pre-tax money. So we're talking about the traditional 401k here, pre-tax money going to work for you. But the business is giving us this, and they're going to want us to be around for some period of time, and that's what's called a vesting. And on your statement, on a 401k statement, if you're still within the vesting time, you're going to have a vested balance, you'll see. So you'll know. It's not going to be a mystery.
Now, every company is going to have different rules and regulations on this, but you want to understand this just in case you quit, just in case you leave, or just in case you get fired. Because this could be a way to keep you at a company longer than you might like. Now, this has a lot of benefits to you because it's kind of like free money in a sense that your employer is giving you more investment money, but I wouldn't say it's free money because you're still working for it.
It's definitely not free money.
However, you do want to understand the controls that might be tied down to it as well. So what you want to pay attention to is your vesting schedule. Meaning, if you were to leave your company and your employer is giving you a match, they're giving you some money into your 401k, when do you actually get to keep that money? Because if you have to be at the company for, say, 5 years to get that money, you want to understand that and not...
Yeah, and usually on a vesting schedule, each year that you work there, you'll get a higher and higher percentage of the matched amount being vested, okay? So if you were to leave in the second year as opposed to, let's say, the fourth year, you're going to end up keeping a lot more of that in that fourth year.
Not potentially lose it without knowing you're going to lose it. So just something for you to understand. The second thing you understand when it comes to controls has to do with Wall Street. Because when you invest your money in a 401k, what you're doing is you're investing your money into a fund. You're generally not going to be able to invest in individual companies. Like you can't take your 401k.
Yeah, yes, you are. I mean, I'm sorry, but that's just wrong. I apologize. I know I'm getting fired up on this one, guys. But this is just bad info, okay? In your 401k plan, it is limited, okay? And it is limited to funds, and you'll have active managers and index funds. But when you use stock funds, you're owning companies. You're owning individual companies. Now, what he's referring to is you're not able to buy individual stocks. But this whole thing about Wall Street is just bunk. It's not true.
Generally, and invest it into the Tesla stock, or Nvidia stock, or Amazon stock. What you're going to do is you're going to invest this money into a set of funds that your employer has partnered with. Now, what ends up happening here is you're pretty limited on where you can actually invest your money. Like you're not going to most likely be able to invest your money into real estate. You'd have to invest in something like a real estate investment fund, if you're even given that option. And so what you want to think about and remember here is when you're investing in a 401k, this is just one vehicle. It's not your only investment vehicle. I'm going to talk about alternatives at the end of this video, but just know that you have limited control when it comes to investing with your 401k because you have to invest your money into whatever those money managers offer you.
Yeah, and he's keep saying money managers. Look, guys, there are index fund options. You can use active fund managers. But if we use a broad-based index in your 401k, then guess what? Especially if it's a blue chip or a large, what's called large cap or large companies. Well, guess what companies we're going to own? Tesla, Amazon, Nvidia, all the ones that he just mentioned there. We own those too, okay? But we also own a whole bunch of others, so we're diversified and we don't put all of our eggs in one basket and be overexposed.
And those money managers then pretty much manage your money for the next 10, 20, 30, 40 years, and they're gonna charge you a fee for every year that they manage your money, and hopefully they make you a profit. And even if they don't make you a profit, they still charge you a fee. So something you wanna pay attention to is something that you wanna watch, because if you have very limited options, you might want to look at what your alternatives are as well. And the last thing that I want to mention here when it comes to control has to do with rolling over your 401k. So if you leave a company and now you no longer have that 401k, you might have the option to roll that 401k into something like an IRA where you have a little bit more control.
Yeah, and that's true. You leave your employer, you're going to have the option if you want. It's not always in your best interest to do this, but you can roll over into an individual retirement account and then use the universe of investment choices, funds, ETFs, index funds, individual stocks, just about anything that's not collectibles or art and physical property can be invested in an IRA. By the way, in case you're curious, hey, if I work for, let's say, Tesla or Nvidia, and I'm in their 401k program, why don't they offer that company's individual stock in there. Now some do, but the reason why we don't see that so much anymore goes back a little bit of a history lesson here. About 25 years ago in Houston, Texas, here, not too far from where I'm sitting here today. I'm here in Austin, Texas. And so there was this company out there named Enron, okay? And Enron was this huge energy supplier company, very, very successful. This is going back 25 years. And in Enron, in the retirement plan, as an employee, you had to invest into Enron's common stock. And so a lot of the employees did in the late 90s, and Enron stock performed extremely well, okay? The account values went way up in a very short period of time, okay? Well, what happened to Enron? Well, Enron turned out to be a tremendous fraud. There was accounting, there was all these issues with the senior management. Anyway, bottom line is the stock went to zero, okay? So how about being all these poor people out there working at this company for all these years, investing their own money into their future, their retirement, and it all being wiped out, okay? So that's why you don't want to use individual stock, certainly one company, in your retirement plan.
Where you can invest your money outside of those funds, and where now you have control over the money as well. So something for you to think about, especially if you're moving from one company to another, where you're moving over 401ks as well. The fourth thing that I want you to understand has to do with limitations. And this used to be one of my biggest issues with 401ks. I've kind of softened up to many people.
Look, there's really no reason to have an issue with a 401k, okay? Now, all it is being able to plan around it and say, do we use it, do we not? Now, most times it's yes if we're gonna look for planning for retirement, but it doesn't necessarily mean we have to use it or should use it. But there's no real reason to have an issue with it.
That's okay. For some people, maybe not, but for many people, it's okay. But I want you to understand that your 401k is a great place to start investing. It's not where you want to stop investing.
I don't even know what that means. Start investing and then stop investing. I just think that's silly.
This is your beginning to invest fund. This is that tax-deferred account to get you started with your investments, but this should not be your only or sole investment fund. So when I talk about limitations with the 401k, what I mean here is, well, kind of like what I just said, there are a limited number of places where you can invest your money. You're going to get a few funds where you can invest your money, and that's pretty much it. You can't diversify out of those things. And you might say, well, Jaspreet, well, I invested some of my money into a growth fund, into a blue chip fund, and into an emerging market fund. Aren't I diversified? And no, you're not, because all of your money is tied up in paper investments.
Yeah, paper investments, right? That's true. This is true. Your typical return long-term in stocks is somewhere in the neighborhood of 7 to 12% rate of return compounded, okay? Long-term, right? That's a good rate of return, right? Residential real estate usually is somewhere lower than that, okay? And so, but it is important to be diversified, and I think he's correct in that. And we want to evaluate all of your portfolio before we're going to make decisions. Evaluate your entire investment mix.
All of your money is tied up with money managers on Wall Street. So if the stock market crashes, all of your funds go down.
Yeah, this is crazy. I just don't understand the mindset of it's all tied up in Wall Street. That's just, I'm sorry, that's totally bunk and not true.
Maybe some will go down more than others, but you get hurt when the stock market goes down. That's not real diversification. And this is where I want you to understand that when it comes to your 401k, it's a great place for the average person to start investing, but it's a horrible place to keep all of your investments.
I don't think I agree with that either. Why is it so horrible, right? I just don't understand why it's just so horrible. Now, do we want to have everything there? Probably not. But I don't see why it's just so horrible. Yes, the stock market will fluctuate as our economy goes through expansion and contraction, the boom and bust cycles of Wall Street. We will have periods of growth and then also periods of decline. Okay, that is expected. Okay. There could be stock market crashes, right? But if we look at a long-term chart of the S&P 500, I just don't see where the big issue is with it being such a risky thing long-term. Now, we start talking about 5 years or even 10 years, that's a different story. But we're talking about planning for retirement here. We're talking about long-term money, okay? We want to live a long time. And so this is money we're going to be using 20, 30 years or much longer.
because you gotta have some more investments outside of a 401k. That might include investing your money outside of a 401k into an IRA or into individual stocks, into your self-directed account. That might mean investing your money into real estate. That might mean investing your money into startups. That might mean investing your money into other alternative assets.
Now, why would anyone want to use those things, right? He mentioned startups, individual stocks, other assets, right? So what's going on there? And the reality is what's going on there is that we're chasing returns. We're trying to get bigger growth. We're trying for that get rich quick stuff, okay? And I just can't emphasize this enough. That has been proven to not work, okay? We are in the midst of a tremendous bull market today, okay? Here we sit in, this is February 2025, okay? Phenomenal bull market that we've been in here the last 5 years, okay? There's been so much growth, and this is where we see exuberance. People just think they need to have these huge returns. Guess what? It doesn't last.
Outside of these basic investments, but you have to invest your money outside of your 401k as well. So don't treat your 401k like your only investment, make it the beginning investment. And this brings me to number 5.
I still don't know what that means.
The alternative to your 401k, because the 3 asset classes that have built more wealth than anything else in the United States over the last century are stocks, real estate, and businesses. Now your 401k is one way that you can invest in stocks, but it's not enough.
The stocks that you own are in fact businesses, okay? And so again, I agree that it's good to be diversified and have a decent mix there going on. And this, again, shameless plug. This is why you want to work with your certified financial planner. If you don't have one, I'm here for you. But the idea is that, you know, have a professional review everything for you. Even if you're a sophisticated investor, even if you think you have everything together, it can't hurt to have a professional just verify what you have going on. And that will include, of course, your 401k and making sure you're taking full advantage of it. Or it may be something where I've had clients, situations where their employer offers a match. Everything looks good. It's a short vesting, or they've already vested. But there's other things going on with their personal finances that at the time it makes sense to not contribute to the 401k, so we can do other things for the time being and then eventually be able to come back and contribute into the 401k later, okay? And so anyway, I really hope you guys enjoyed this video. Again, this is Scott Schiller. If you've hung with me this long, I thank you for sticking it out. Hope you got a lot out of it. Please like and subscribe to my channel. And then if you'd like to schedule a discovery call with me, please visit my website. It's schillerwealth.com, and you can set that up. And anyway, thank you so much. Have a great day. Stay happy, stay healthy, stay awesome, and I'll see you in the next video.